The $18 trillion debt problem nobody talks about. Imagine waking up tomorrow and discovering that American households collectively owe nearly $19 trillion. Not the government, not corporations, regular people. Mortgages, credit cards, car loans, student loans. And here's the strange part. You probably don't feel like you're living in a financial crisis. You go to work. You get your paycheck. You pay your bills. You buy groceries. But underneath the surface, something is happening. America has built an economy where millions of people are living their lives, one monthly payment at a time. And the real question isn't just how much debt Americans have. It's this: what happens when people can no longer afford to keep paying it? According to the Federal Reserve Bank of New York, U.S. household debt reached approximately $18.8 trillion in the first quarter of 2026. That's a massive number. But the number itself doesn't tell the whole story. Because this isn't one giant loan. It's divided across millions of households. The biggest piece is housing. Americans owe roughly $13.2 trillion in mortgage debt. Then there's about $1.7 trillion in auto loans, around $1.7 trillion in student loans, and approximately $1.25 trillion in credit card debt. Together, these debts create a financial system that depends on one thing: people continuing to make their payments. And when everything goes right, the system works. You earn money. You pay your mortgage. You pay your car loan. You pay your credit card. And life moves forward. But when income falls or expenses rise, the entire system starts becoming much harder to maintain. Credit cards are where the problem becomes especially visible. Think about a person who earns $4,000 a month. Their rent or mortgage takes $1,500. Their car payment is $500. Insurance, groceries, utilities, another $1,200. Suddenly, they're left with only $800. Then their car needs a $1,000 repair. So they reach for the credit card. Swipe. Problem solved. But the next month, the bill arrives. Now they have less money available than before, so they use the credit card again. And slowly, the credit card stops being a convenient payment method. It becomes a second paycheck. That's when debt becomes dangerous. Because debt isn't just about the amount you borrowed. It's about the interest. Imagine borrowing $10,000. If the interest rate is low, paying it back may be manageable. But when borrowing becomes expensive, your monthly payment can start eating a larger portion of your income. And this creates a cycle. You earn money. You pay debt. You have less money left over. You need to borrow again. Not all debt is automatically bad. A mortgage can help someone buy a home. A student loan can help someone get an education. An auto loan can help someone get to work. The real problem is when debt grows faster than a person's ability to repay it. And that's where the warning signs appear. In the first quarter of 2026, the New York Fed reported that 4.8% of outstanding household debt was in some stage of delinquency. The debt problem isn't disappearing. The biggest danger isn't necessarily the $18.8 trillion number. It's what happens when debt meets an economy where people are already struggling with everyday costs: rent, housing, insurance, food, healthcare, childcare. Everything adds pressure. The Federal Reserve's latest household survey found that 23% of renters reported being behind on rent at some point during the previous year. So the real story isn't Americans are irresponsible with money. It's more complicated than that. It's that the modern American economy increasingly runs on a combination of income plus credit plus monthly payments. And when those three things stay balanced, everything feels normal. But when one breaks, the entire financial picture can change very quickly. So, what is the $18 trillion debt problem nobody talks about? It's not simply that Americans owe too much. How much of their future income is already gone?